Welcome to F9 Financial Management. In this section, I will go over sources of finance and their relative costs. Please review F4's videos on loan and share capital to revise the basics. In this video, we are going to go over the following: debt versus equity, the creditor hierarchy, issues with high levels of gearing, and using the weighted average cost of capital versus the capital assets pricing model in investment appraisals. You'll have seen this from earlier videos, that there are two categories of finance within a business: debt and equity. Debt financing is sourced from outside the organisation. A bank loan is a common source of debt financing. The costs of debt financing is the interest rate charged by the lender. This will depend on a variety of factors: the creditworthiness of the organisation, the current market conditions, the amount of finance being sought, etc. Debt financiers often require collateral for loans and will take a charge or can take a charge over companies' assets. If the company fail to keep their side of the agreement, the financier can take the asset. Companies' creditors can put the company into receivership and liquidate the company if they are not making their loan repayments. Because of this, debt financing is seen as adding more risk to a company. In business, every investment has a risk. Some shareholders and business owners believe that debt financing is good because the risk associated with it motivates the directors to work hard and create a return to meet the loan repayments. Using debt financing to fund an organisation increases the organisation's gearing. You should already be familiar with gearing, which I will go over later in more depth. Equity financing is sometimes called internal financing, as it is the shareholders' funds. It can be mistakenly viewed as free finance because, unlike a bank loan, there are no scheduled loan or interest repayments. But these are the shareholders' funds in the form of share capital and retained earnings, etc. These investors want a return for their money invested. This return is the cost of finance, and this is the opportunity cost also associated with their funds because they could put it into another project. Equity financing will reduce gearing, but it can also reduce the current shareholders' power. So, for example, by issuing more ordinary shares, you're diluting the current shareholders' control in the company. So, debt versus equity financing. When looking at finance, you will need to assess debt and equity financing under these following headings. So firstly, gearing and financial risk. Debt, as I've already said, increases the gearing and financial risk. Equity reduces it. So the target capital structure. So the goal of target capital structure is to minimize the weighted average cost of capital. Debt is a cheaper source of finance initially. It must be controlled because otherwise the company will risk financial distress. Equity reduces gearing, and to obtain the ideal capital structure, a mixture of debt and equity need to be maintained. Collateral. Debt finance, as I've said, often requires collateral which will place a fixed or floating charge over the asset. Equity funders don't receive collateral, so the organisation doesn't need an asset to offer a charge over, but instead they have ownership and control of the company. Economic forecasts and expectations. This will dictate the type of loans that the company will undertake. If they expect interest rates to drop, for example, they may choose a variable interest rate loan. And then when investors are looking at their economic forecasts and expectations, they will have certain ones and the returns that they would expect that their investment to achieve. Control. Mentioned this a few times. Debt financing increases the risk but does not dilute the control in the company. So if a company gets a bank loan, the lender cares about the repayments of their loan. They don't have an involvement in how the company is run and how these repayments are made. However, equity financing does have control. The shareholders own the company and have control, so they will have an input into different decisions. The creditor hierarchy. You should already be familiar with this from earlier videos, but let's go over it in more depth. You should know from your studies of investment that the greater the risk, the higher the return. When we examined investment appraisal, you learned about the risk premium applied to investment projects. When an organisation is seeking finance, it is flipped. Instead of appraising the investment, you must view as the organisation as the investment. With this viewpoint, let's look at the creditor hierarchy and the costs associated with the finance. In the event of a winding up of a company, debt financing is paid before equity holders, who are paid after all creditors. First paid are the debenture holders. These are the lenders who secured a fixed charge over an asset. The asset is usually in the form of property, like land and buildings. Since these lenders didn't take a high risk, they had security over the finance that they loaned to the organisation, so the cost of this finance is relatively lower than the following creditors who come after them in the creditors hierarchy. Creditors who had a floating charge over the assets such as inventory. They are more protected than unsecured creditors, but they're also not first paid like the secured creditors who have a fixed charge. Then we have the creditors who are protected by the law. So, for example, in many countries, tax authorities and the employees must be paid before unsecured creditors and shareholders. Next to be paid in the hierarchy are the unsecured creditors. For example, suppliers will be paid. Then we have the equity holders. So the preference shareholders are paid back their investment. And then, after everybody else is paid, we have the ordinary shareholders. They take the most risk. As you can see, they are the only group who didn't get a predetermined amount. All creditors have received amounts billed and the preference shareholders received back their investment, but the ordinary shareholders will receive the balance. As you can imagine, this can be much higher than their initial investment, meaning they can make a big return. But from this hierarchy, you can also see they may receive much less than they invested. Ordinary shareholders face the greatest risk, and their finance as a source for the company is the most expensive. Its cost is the risk-free rate of return plus the risk premium attached to it. The cost of equity finance is also the investor's required rate of return. Given that equity financing is expensive, why not just borrow all the finance? Debt financing, as you've learnt from previous videos, increases the company's gearing. It is acknowledged that some level of debt financing is good for the weighted average cost of capital of a company because it is a cheaper source of finance. But high levels of gearing pose many problems. A highly geared company is considered more risky and is more vulnerable when there is a downturn. This could be in the economy or in consumer demand for the company's product. If they experience dropping sales, they cannot meet the loan repayments. This may cause them to be put into receivership, putting the company into a winding up situation. If they are not wound up, but experience repayment difficulties, the organisation can damage its credit rating, which will reduce finance available to them in the future and may even prevent certain suppliers supplying them with credit. The cost of servicing loans will reduce profits, reducing shareholders' dividends and returns. This could cause them to sell their shares, leaving the organisation open for a hostile takeover. As you can see, there are a plethora of problems associated with high gearing, and this is why having a proportionate amount of equity finance is considered to strengthen a company, and it will be able to service its debt requirements during a downturn, avoiding the problems we've just discussed. So, how do you know if a company is heavily geared? It is important to look at the industry that the company is in. What is the debt to equity ratio of similar sized companies? If it is similar, then it is at an acceptable level. However, if it is significantly higher, it may be too highly geared, and efforts should be made to reduce it. To measure gearing in an organisation, you can calculate it with the following ratios. I discussed ratios in F3 ratios. I recommend that you look at this video and earlier ones. With these ratios, you can look at the extent of the gearing of an organisation and compare it to similar organisations and to the previous years of the company. First is the debt to equity ratio, where you divide the total debt by the total equity. This shows a debt as a percentage of equity. The higher this number, the more highly geared the organisation. Now there is the interest cover ratio. This takes the earnings before interest and taxes divided by the total interest. The higher this number, the better, as it shows the organisation's ability to service its debt. What this number should be depends on the company and the attitude of their investors. A 2 or higher is considered sound, but some companies may require a higher number and others a lower one. Next is the equity ratio, where equity is divided by the asset value. This will indicate the level of leverage of the company and how much of their assets are financed with debt. The higher this number, the more assets are financed by equity. And finally, the debt ratio. This ratio looks at how much the assets have been financed by debt. The total debt is divided by the total assets, and the higher this number, the higher the gearing, and the more assets that have been financed by debt rather than by equity. Debt financing is a very important part of business financing. It is cheaper than equity, as I have said, and its interest costs are tax deductible. However, as you can see the problems arising from gearing, it must be managed carefully. Another type of gearing is operational gearing. This examines the relationship between fixed operational costs and the organisation's overall operating costs. This is examined with the following ratio: fixed operational costs divided by the total operating costs. The higher this number, the more operationally geared this organisation is. This means that if they experience a downturn, they will still have to incur these fixed costs, making it a more risky organisation. On the flip side, with high levels of operational gearing, the cost does not increase with high levels of production and consumer demand, so the organisation can get higher profit margins and avail of economies of scale. Operational gearing is determined by the industry the organisation is in. However, as the organisation can suffer serious losses when demand dips, they will need to forecast and manage this. The gearing we have discussed is risk for the shareholder, and cash flow forecasting can manage this risk, as management will predict future cash flows and match this to debtors' requirements and their equity holders' rates of return. Obviously, their forecasts may not always be accurate, but some future planning is needed, and it can help manage equity holders' expectations. Funding an asset. One of the main reasons an organisation undertakes financing is to get an asset. They can do this by leasing the asset or borrowing to buy the asset. Leasing finance agreements have changed a lot in recent times, and it is important that you do read the terms and conditions of these agreements carefully, particularly over the area of ownership of the asset. But typically, when leasing an asset, the organisation doesn't own the asset, or doesn't own it until the final lease payment is paid. The leasing company does, and if the organisation fails to make any of their repayments, the leasing company will take the asset back. Leasing agreements differ, but they may offer additional support like maintenance, which will reduce the risk of ownership. If, say, for example, the asset breaks down, they may also replace the asset if it does break. And if the organisation, for example, no longer wants or needs the asset, they can exit the agreement. So, while they may have to pay a penalty clause to do this, but again, it offers greater flexibility. When an organisation borrows to purchase the asset, they incur all the risks and the rewards of ownership, and the extra supports that were available, say, under lease agreements, may not be available. They'll have to get them separately. However, the asset will be theirs. If they no longer need the asset, they'll have to sell it. It's not a case of paying a penalty clause and the asset is taken away. As you can see, owning an asset is riskier than leasing it, and obviously the lease repayments are a little bit more expensive. The management will have to analyse the costs of both options. An NPV analysis is good to do this. So, when we are looking at the mix of debt and equity capital, we are looking at the cost of each. How do they impact the investments that are made? Well, as you've seen from investment appraisals, the discount factor used is largely based on the cost of capital, and a risk premium is then added depending on the project's risk. So, the lower the cost of capital for a company, the lower the discount factor, and the more projects will get a positive NPV when assessed. The weighted average cost of capital can be used in investment appraisal when the project is relatively small, the current capital structure is maintained, so the debt and equity structure remains the same. The project has the same business risk or operating risk. Business risk arises from the nature of the organisation's operations, so their operations will remain pretty much the same. So, what if the company has a project that doesn't meet this criteria? When we look at the capital asset pricing model, which you will have seen in earlier videos, this model examines the cost of equity, which is based on the risks faced by the shareholders. What are the advantages of the CAPM over the WACC when management wants to decide the cost of capital of a specific project? CAPM is used to look at projects that have a different business risk than the company's normal business risk. This model focuses on the shareholders and to maximise their wealth. The model can set the required rate of return that the shareholders want. This may be higher than the WACC given the project has a different risk profile. So let's apply the CAPM. ABC Incorporated had difficulty sourcing finance after the global recession, and it is an all-equity company with a beta of 0.7. Management are looking at investing in a one-year project, which requires an initial investment of $10,000 now. The project will give an expected return of $12,500. This project has a beta of 1.4. The risk-free rate of return is 10% and the market rate of return is 18%. So, looking at this example or this question, what is ABC's cost of equity? So pause this video and attempt. Have you done it? We know that the company has a beta of 0.7. This project has a beta of 1.4, so the risk profile is very different. If this was a risk-free investment, the beta would be 0. The risk-free rate of return is 10% and the average return from the market is 18%. ABC's cost of equity is found by the risk-free rate added to the market risk premium, which is multiplied by the company's beta. So that is 10% plus and then 8% multiplied by 0.7. This gives us a result of 15.6%. So now, what is the cost of financing this individual project? Pause this video and attempt to calculate this now. So, have you done it? Okay, let's begin. The risk-free rate added to the project's beta multiplied by the market risk premium. So 10% plus, and then we've got the risk premium of 8% multiplied by the beta of the project, which is 1.4. That gives a result of 21% and 0.2. So 21.2%. This is substantially higher than the company's cost of equity, but the risk profile of this project is also much higher. Now, should the company invest in this project? Pause the video and calculate your answer. Done? First, we calculate the expected return of the project. So, in 1 year, the cash flows will be $12,500. Deduct this from the original investment of $10,000 and divide it by 10,000. And the return, or the expected return, is 25%. This is above the minimum expected return for the investor, which is 21.2%. So it should be selected. Now, you've probably spent a lot of time looking at the NPV when you're assessing investment projects. So would the NPV tell us that this is a good project? Let's calculate it. So, as you can see from your calculations, the NPV is a positive one. It returns $313. So it is positive, showing that yes, the project should be selected.